All right, so let's talk about the common tax mistakes, so what I call the top 10 tax mistakes made by most self-employed business owners, right? Is everyone here self-employed?
Yes.
Okay, good. All right, so everyone can take these deductions and take these write-offs. So first of all, we're going to talk about hiring your kids. Does anyone have kids between the ages of 7 and 17? Awesome, good. Does anyone have grandkids between the ages of 7 and 17?
Not yet.
Not yet, okay. All right, so what hiring the kids strategy is basically doing is saying the kids are going to be working inside the business, right? So if you make over $300,000 a year, which I hope you do, then you'll be at a 32% tax bracket, right? So let's say 32%. If you're not quite there, you're in the 20-something% range. But if you're in the 22 or 24%, you also have self-employment taxes, which are 15%. Self-employed. So 22 plus 15 plus California is way too much, right?
Oh, yeah.
So essentially what we're doing is we're saying kids can make up to $12,000 a year, which is the standard exemption limit. They can make up to $12,000 a year, and how much taxes do they pay?
Zero.
Zero, right? So you're changing 32 to what?
Zero.
To zero, right? Who wants to make a 32% return on their investment or 32% return on their money, right? Has anyone done that consistently and legally? So that's what hiring the kids does, right? And you can do up to $12,000. What can kids or grandkids do for your business?
Take out the garbage.
They can take out the garbage.
Shred.
They can shred. They can file.
Stuffed envelopes.
Stuff envelopes. For real estate agents, they can door knock, right?
Run QuickBooks.
Run QuickBooks, right? So, and of course, depends on their age, right? So the 7-year-olds are probably going to be shredding and scanning and filing. You know, maybe 12, 13 years old, they can start learning QuickBooks. Maybe 16 or 17, they can start learning marketing, social media management, things like that. The kids are on their phones all day anyway, right? So they can do some work while they're on there. So if you could shift, let's say, $10,000 of taxable income from a 32% to a 0%, $10,000 times 32% is how much? $32,000. If you had 3 kids, what is that worth in tax savings? 10 grand, right? 10 grand. So if you do that for 10 years, you answer my next question, 10 years, that's $100,000 of tax savings. Just by doing what? Right? Basically just having your kids fill out a form saying, yeah, I worked. Do the kids really need to work in the business? Is the IRS going to come knock on your door and say, show me your kids that are working? No.
Can you hire other people's kids?
You can. You can. So I mentioned grandkids, right? So the IRS rules is that they don't pay Social Security and Medicare when they're your kids, right? So if your grandkids or your nieces or your nephews, or if you have, you know, someone else that you want to give money to, essentially all you have to do is have their parents create a Schedule C. And the Schedule C can do anything from marketing to accounting to bookkeeping to janitorial services, whatever you want to do. So basically if you're here and your brother or sister is over here and then their kids are here, you have to pay them first and then it goes to the kids. Right? So then this one has to be a Schedule C.
It has to be family.
What? Who else do you want to give money to?
We can always give them
You want to give money to my kids? You can pay $10,000 a year to hire my kids. I'll take that. So yes, and then you can use that for grandkids as well, right? So if you're the grandparent, and then this is the parent, and then the kid, so you just have to go to the parent. And then the parent is basically creating the business. So the parent is in charge of the marketing or the advertising or the bookkeeping or accounting, janitorial services, whatever you want to do. You're paying the parent, and then the parent is paying the kids for them to work inside the business.
You both get the deduction.
Well, it's tax-free. So you get the deduction here of 32%, and then when it goes to the kids, it's tax-free. Yeah. Yep.
Does this apply if you have a S corp?
If you have an S corporation, the kids hired in the S corporation have to pay the 15% self-employment tax. So what I recommend is do a similar strategy where the S corporation pays you as the Schedule C and then pays your kids. So by doing that step away from the S corporation, you can take advantage of it.
Or you can just, as a regular employee, run it, that would not help.
If you want to pay money to Social Security, do you want to pay extra money? Do you want to pay an extra 14% a year to Social Security? I don't even know if it's going to be there for me when I'm 65, right? All right, yeah.
So pretty much the S Corp would pay, like for me, I'm the parent, and then I would issue my daughter
If you're serious about doing this, call me.
yeah.
Yeah, let's set up, because there's child labor laws and there's workers' comp and there's other stuff like that. The last thing I would want to do is hear that you got carted away. And all right, so the next one: contribute to kids' college or Roth IRA, or pay for their college expenses. So there's three things here. The kids' college is the 529 plan, right? The 529 plan is pretty vanilla, if you ask me. They made some changes in 2018 where now you can use that money for, I think, some homeschooling expenses or some private school. Are you going to get great benefits from the 529? No. What you are going to get great benefits, though, is using the Roth IRA. So going back to the strategy that I just told you, now the kids have earned income. And what's the rule for Roth IRA? What do you have to contribute money to a Roth IRA? Bueller? Earned income, right? So if you have earned income, which now your kids do have, you now have earned income, and you can contribute to a Roth IRA. And Roth IRAs are pre-tax, right? But if they're paying tax at a 0% rate, Roth IRAs do what? Grow tax-free, right? Roth IRAs go tax-free, and then they take that money out whenever they want, completely tax-free, right? So they're always going to be paying what? Zero, right? So let me give you an example. Let's say you do this scenario and you pay your kid $5,000 a year for 10 years. You have $50,000. And you take that $50,000 and you invest it with Gary, and you talk, with what Gary's got going on, right? I know you can't get much for $50K, right? But so maybe you put some like a second hard money loan, and then you have enough to do a land deal or something else, right? So then they have this money invested. Let's say they're earning about 10% a year, and they take that money out when they turn 65. How much money will they have completely tax-free when they turn 65? $1 million, right? Does anyone know anyone that's ever received $1 million completely tax-free that wasn't life insurance? No. So is that a pretty cool way to get $1 million completely tax-free? Oh, and by the way, if you're at a 32% bracket, you saved yourself 32% on putting that money in and then letting it grow completely tax-free. All right. College expenses, if you have a business like an S corporation, you can set your kids up as employees, and then if they're employees of you doing certain tasks for the business, and then they also are going to college, and their college degree is associated with what they're doing for the business, can they be classified as an employee, and can you write off their college expenses? Yeah. It's called a fringe benefit. So fringe benefits will allow you to pay college tuition, college expenses.
What's the definition of related?
The tax law has a lot of gray area, so you'll notice that whatever's related, whatever you're comfortable with, whatever you're willing to fight for. Okay, the next one: hire your parents. This one's going backwards from the hiring the kids. So if your parents are on a fixed income, maybe they're just getting Social Security or Medicare or whatever, could you, if you were at a 32% rate, shift that income up and take advantage of, let's say they're at a 10% or a 15% bracket? So you're shifting income from a 32% to a 10%. Is that pretty cool? How can your parents help your business? I don't know. How could your parents help your business? Could they help you door knock? Could they help you stuff envelopes?
I'd pay them to stay out of the way.
You know what I really like is
Consulting.
Exactly.
And you can also pay them as much as you want.
Do consultants make whatever they want?
Run errands.
You can go up to 10 to 15% as much as you want.
Yeah. So consultants can charge whatever they want, right? So if your parents were, of the baby boomer generation, and you said, hey, could you help me as a consultant get more listings as a real estate agent for baby boomers, right? What do baby boomers like talking to real estate agents about, right? Or if I went to someone that's a baby boomer, as another baby boomer, what things could we talk about? Or should I bring a gift? Or should I do this, right? So could you pay a consultant $1,000 a month to do something like that?
Oh, yeah.
Yeah.
So can you pay them like $10,000 a month?
It's sort of reasonable.
There's really no limits, no.
Really?
But the problem is what you're doing is you're shifting it so then at a certain point, if they make more money than you do, then their tax bracket's going to be higher than you do, and then it doesn't make sense, right? So that's really the only limiting factor. Yeah.
I understand.
Yeah. So if you had, 10 people in your family that you could do this to, and you were making $1 million, right? So you could take $1 million, divide that by 10 people, and each person makes $100,000. So everybody is at, a 22% tax rate, 15%, 22% tax bracket, instead of you at a 39.5% tax bracket, right? So you save 50% in taxes. Is that pretty cool?
Oh, yeah. Can you hire your parents to watch your kids so you can go to work?
Yeah.
Oh,
Yeah. Yeah. All right, tracking your miles, right? Does anyone drive for work? Yeah, all right. If you're not, you're probably So you should always be tracking your miles. I really like an app called Mile IQ. It's actually a Bay Area-based company, which is really cool because we're supporting local. And the Mile IQ app, I really like it compared to other apps that I've seen because it does one very important thing, and that is it allows you to track 2 vehicles instead of just 1. So when you turn on the app up in the corner, it'll say what vehicle you're driving. You can switch that, right? Now, why is it important to use more than 1 vehicle in your business? It's important to use more than 1 vehicle because if you're using 2 vehicles, you get to depreciate both vehicles. There's that crazy depreciation again, right? So let me give you an example. This is me and my wife, right? So I'm here in my car, and I'm driving everywhere, right? I've just tons and tons of miles, right? So I'm driving, let's say, 20,000 miles a year. And my wife, I'm just making it, right? Easy numbers. And then my wife, she's just driving the kids to soccer and baseball and to school. I mean, we live like 2 minutes from school, so we walk most of the time. But let's say my wife only does 10,000 miles a year, right? So that's her SUV. I'm an artist. No, I'm an accountant, not an artist. So what I do, if normally I do 20,000 miles, how could I use both vehicles? Well, if I switch my 20,000 miles and I drive 5 of them here, and my wife does those, let's say 2 here. Is there a fee for it? Yeah. All right, so let's say I move 5,000 of my miles over here. She moves 2,000 of her miles over here. What does that do? That increases this to over 50% business. Now I have 2 vehicles that are more than 50% business. So if I have 2 vehicles that are more than 50% business, I get depreciation. Not James's depreciation when you drive the car off the lot, but you get that crazy magical IRS depreciation. Oh. Who else has a CPA that hasn't talked any of this stuff about them? Right? All right. And how hard is it for me to just drive 5,000 miles in her SUV? Not, right?
What is it? What's the max? Is it $7,000?
For depreciation? It used to be. They upped it now. It's I don't have the numbers in front of me. I don't want to bore anybody with numbers, but the numbers are better now with 2018 than they were ever before. So yes, you'll be able to write off more of your depreciation on those vehicles. But before, this was what? 0. But just by shifting some of my miles over to that second vehicle,
Shifting how much? 50% of your miles?
so, well, I have to have more than 50% for that vehicle for business, right? So if she was driving 10, and she drives 2 in my car, and I drive 5 in her car, that immediately increases,
With business. Got it.
yeah, more than 50% for business. Then you can depreciate the vehicle, right? What does that do? It just creates this magic wand, right, just creates depreciation out of nowhere. All right, tracking your miles. So yeah, use MileIQ. Yeah.
I've got a dedicated truck for business, so do I need to track my miles?
Yeah, yeah, because the IRS is going to want to know where you were driving, what the miles were for, who were you seeing, all those related.
Can you backlog?
Yeah,
Like,
yeah,
Got a calendar.
yeah.
That's
So,
my appointments.
so the IRS, yeah, go ahead.
I was just going to ask, so what about instead of doing miles and just dedicating, he's kind of, the whole vehicle is dedicated.
Yeah.
So do you just get the whole vehicle? Is that better than you don't have to track miles?
Yeah, so here's the thing. So your question, when do you need to do it? The contemporaneous mileage log is what they call it. It should be updated at least every week. So if you haven't been tracking your miles, and you know we've already had X number of weeks throughout the year, right? So technically those are all outdated, right? So you should have done it, but you didn't. If you do it and I don't know, then that's okay. I'm not gonna tattle on you. But yeah, you should be doing it every week. So the problem with 100% vehicle is that no one drives their vehicle 100% for business. There's always something that you're going to do personally, right? Your wife's going to call you or your kids are going to call you and say, hey, go pick up my dry cleaning or go pick up a gallon of milk from the grocery store, right? So there's always going to be one drive or more, right, that are personal in nature. So yeah, the IRS is they're on a lookout for seeing vehicles that are 100% for business. They're like, you can't do 100% business. Right? Does that make sense?
Even if it's a company car, it's not 100% business.
Yeah, even if it's a company car, you're going to be taking more advantage of it, right? You know, you're going to take that wherever you can. Yeah.
So there's not really a viable alternative to tracking miles?
90%.
There's really not. No. Because they're going to want to know where that vehicle was going, right? And if it's a corporate vehicle, they definitely want to know where that. I mean, they're throwing GPSs on those now because they want to know. I want to know exactly where that vehicle was, right? If it's involved in an accident, I don't want to know exactly where the vehicle is. So that's why the GPS through the MileIQ is really good. The other question I get asked a lot is the 90 days. So can you keep a log for 3 months and is that okay? Yes. Some auditors don't know that rule. Some auditors may say, no, I want the whole year's worth of, but yeah, usually you can get away with 90 days or 3 months.
So they consider that a sample of the year.
Exactly right. Yeah. So yeah, but it's a lot easier to keep track of 3 months as opposed to 12 months, right? But you may be missing out on deductions because of different times.
So
Yeah.
I get reimbursement for my mileage,
Uh-huh.
but the reimbursement really isn't full reimbursement. Can I manage to get the rest of the reimbursement from the government?
You used to be. In 2017, you had the 2106 on unreimbursed employee expenses.
Yeah.
You don't have that anymore. They got rid of that form in 2018, right? Do you have any other employees, mortgage brokers? Anybody? No, okay. Those guys, they got hosed in 2018. You can't take the 2106. Yeah, and some mortgage brokers I know that are making, you know, $300,000, $600,000, $700,000 a year. They were taking $100,000 or more in write-offs, and now they can't anymore. They're not happy. Not happy. All right, next one. Have items as advertising instead of gifts, right? So can't tell you how many times I've seen this. Oh, home office. I missed the home office. Okay. So if you're a Schedule C, you don't have a S corp or anything like that. You want to take the office and home, right? So a lot of CPAs say, no, don't take it. It's a red flag. It's not worth it. The reason that it's not worth it is because you only get a small percentage, right? If you look at the safe harbor is $5 per square feet, right? So if you have, let's say, a 100 square foot office, $5 a square foot, that gives you a $500 tax deduction. At a tax rate of 22%, that only gives you $100, right? Who wants to save $100 on their taxes, which is something that could be a red flag? No one, right? However, what these people don't tell you is that the home office unlocks the drive between your home as a business location and your first business location. So if you're not taking the home office, your home is personal if you don't have a home office, right? So your first drive from your home to your first destination is considered a personal drive, right? A non-business drive. But if you have a home office, your first drive of the day from a business location to a business location is now considered a what? A business expense, right? So if you lived, let's say, 10 miles away from your office, and you did that drive twice a day for 50 weeks a year, right? So with 10 times 2 at 56 cents a mile, I think that comes out to like $10,000, maybe $5,000, something like that.
Or if you drive from your home to San Francisco, here,
Yeah.
that's your first drive of the day, that whole drive is not.
Exactly right. Right. So what does the IRS want to see when they're doing that as far as what is a home office? The home office has to be separate and distinguishable from your other office, and you have to have different reasons for having both offices. So at home, do you check your email? Do you read the newspaper or Wall Street Journal? Do you check your business mail? Do you do bookkeeping or accounting or some sort of receipt management or record keeping, right? Do you do that stuff in your other office, right? So if you work for Keller Williams or Realty One, do you go to your Keller Williams or your Realty One office and you start opening up your mail and start paying your bills there in an office? Do you guys do that? No. Does anyone do that? No. It's just like, why are you doing that, right? So you have two separate and distinguished offices. You have one for admin, bookkeeping, record keeping, opening mail, stuff like that. And you have one to meet with the team, meet with your admin staff, do sales, presentations, things like that, right? So two completely different offices, separate and distinguishable. You can take then the business drive between the two.
And that doesn't work with an S corp.
So the S corporation should be using an accountable plan to reimburse you as the employee for using your vehicle, unless the S corporation owns the vehicle, and then they can take the write-off. Yeah.
Now, this is a really weird situation. My office is in the cloud.
Okay.
So when I launch up to the cloud, can I just out to
Yeah. Well, you need a rocket or something for that, right? So I don't know. Elon's getting the price down on rockets, so we should be able to do that.
No, I am serious. I'm serious.
Yeah. Yeah.
So my area is deductible.
Yeah. All right. So next one, have items as advertising instead of gifts, right? So this is really important for real estate agents specifically, or if you're giving gifts, try to brand it in a way that it's branded specifically for you. And then it's not just, you know, hey, here's a bottle of wine that's $100. Because if you just give someone a bottle of wine, let's say it's a $100 bottle of wine, the gift limitation kicks in and you only get $25 for that, right? So how do you get the full deduction for it? It's got to be advertisement, right? So a bottle of wine, what you can do is you can put your label on it. You can get custom labeled bottles of wine. So now that's advertising instead of a gift. Cutco does knives and things like that. Business cards are a great example. Real estate agents with their business cards, they have the option of doing what's referred to as a passport card, which if you guys know what a passport card, they give you like half off at restaurants, 2-for-1s, other discounts like that. So if you have the passport card as your business card, then it's advertising and it's 100% deductible and not gifts.
Wouldn't
Yeah.
the business card be advertising anyway?
It is, but what do you pay Vistaprint for your business card? A fraction of a penny, right?
Right.
But what's the passport card? It's like 60, 70 bucks, right? So that gives you the ability of what could be considered a gift, but because you've branded it and have your advertising on it, and it's considered an advertising expense. So think outside the box and challenge yourself to think outside the box to find these deductions. You can do the same thing with travel, right? So if you want to go to Lake Tahoe to go water skiing, what other things could you do in Lake Tahoe to make it a business deduction instead of a personal trip?
Go to an open house.
Talk with other agents, referral agents, right? If you
How
go,
do you prove this to the IRS?
it's all about documentation, right? You want to keep as much documentation as you can.
Email exchange.
Email exchange, photos, pictures, mileage log. MileIQ is going to be GPS tracking to prove you're actually there. Notes from business meetings. If you're up there enough, you might want to look at purchasing rental property up there so that every time you go to Lake Tahoe, you're looking at your rental property. So every time you drive there, you're deducting that mileage. If you have parents, let's say your parents have moved out, they're in like Chicago. If you purchase a rental property in Chicago, every time you visit your parents for Thanksgiving or the holidays, that trip then is deductible because you're not going to see your parents for Thanksgiving, you're going to check on your rental, right?
So can you say, I'm gonna go there because I'm considering purchasing a property there, right? No, not unless you have something. Okay.
Well, wait a minute, if you
Yeah.
write a contract,
Yeah,
and you can show that, but you didn't get
Yeah.
accepted,
right.
that's absolutely deductible.
Yeah,
Yeah.
yeah.
Take it off.
It depends on the intent, right?
Yeah. If it was just-
Yeah,
So if you're going there to look at properties, you can't until you buy them. Can you then?
bingo.
Or at least put an offer.
Unless,
Exploratory.
unless,
don't count.
yeah, I mean, if you want to be really aggressive, you could put it on your taxes. If it gets challenged, you might lose it, but yeah. You can put whatever you want on your taxes. If it's your form, you've signed it, you can put whatever you want on there. Okay, employee benefits, de minimis, we kind of talked about this, the college expenses. There's other de minimis benefits. So if you have a corporation, you can write off your coffee, your donuts at home, breakfast. Sometimes if you need to work late, you can bring in food and things like that. You can write that off as de minimis. Turkeys at Thanksgiving, pies at Christmas, that kind of stuff. De minimis benefits.
And that's only if you're a corporation.
You would need a corporation to do that, right? Right? So that brings up a really good point. A lot of times people ask me, what's better? Should I do an LLC? Should I do an S corporation? Should I do a C corporation? Why not have all three?
Why?
You are tricky, Jay.
Why not have all three? Then you,
Say more about that.
well, it's complicated for your CPA. Your CPA should handle it, right? So what are the benefits of the C corporation? De minimis benefits, employee benefits. Did you know that if you have a pool in your home, does anyone have a pool at home? You know you can write that off as a corporate athletic facility
Whoa.
in a C corp, right? If you have a home gym, is that a corporate athletic facility?
Yeah.
Yeah. So that means you can write off your dumbbells, your running machine, your treadmill, your whatever, right?
If I just have a bicycle.
Your bicycle. Last year there was actually a C corporation travel benefit for bicycles. Did you know about that? You could get up to $50 on every paycheck to pay towards purchasing and repairing your bicycle. So, but who got rid of it? No, we're not going to talk politics. I'm not going.
How do you do all three?
What's that?
What do you mean?
How do you do all three, or be all three?
Yeah. Why do you want three?
You just be all three. Right? Is there differential things that you can do? You can split up your business and you can have some of the business conducted out of the C corporation, some of your business as the S corporation, some as the LLC. Can you split it up like that, right?
And that's for the CPA to do.
Think outside the box. Your CPA is not going to think outside the box. That's not what they're there for.
What's his name is Jake Adams.
I only think.
Yeah.
So you don't want to make
All right.
money in the C corp.
Well, that's a whole other story. We got time?
805.
Okay. Okay. Have a retirement plan. Retirement plans are awesome. If anyone was here, was it 2 weeks ago, 3 weeks ago, we had someone talking about self-directed IRAs. I wasn't able to come. I was really like kicking myself. I wasn't able to come. But self-directed IRAs, you can put money into a 401k, into an IRA. You can self-direct that, and you can basically do whatever you want with it. You can cryptocurrency or land or whatever investment properties. You basically do whatever you want with it. Now-
Don't you get killed on the taxes?
yeah, I don't recommend putting investment property in there because when you put investment property in a 401k or an IRA, it turns it into ordinary income and you lose all the benefits of having the capital gains as your personal, unless it's a fix and flip. So yeah, so what should you be doing with 401ks, IRAs, fix and flips, hard money loans, tax liens, tax deeds, anything like that you're comfortable with.
And all through an LLC.
So yeah, it's referred to as a checkbook LLC. When you have a self-directed IRA and you want to be fluid and use the money as you will, it's referred to as a checkbook LLC. So it sets up the IRA and the IRA is going to invest in that LLC. Retirement plans are also great if you're an S corporation. You can do a 401k. So you can contribute up to $18,000 as the employee. You can do the employer match from your own company to use the employee, another $18,000. If you're married, your spouse can do the same thing. So 18 times 4 is 54, I think, $54,000 of sheltered tax, right? If you want to go better than $54,000 a year, you can go what's referred to as a defined benefit plan. Has anyone heard of a defined benefit plan? A pension plan? Yeah, very similar, right? So a defined benefit plan can actually allow you to shelter up to $250,000 a year, right? And you can do that for 3 to 5 years if you want to. So just kind of giving you guys all this stuff is like, oh, I could do this, I could do this, I could do that. Or if you know of anyone that could think of doing anything like this, just feel free to pick my brain. I'm happy to.
Quick question.
Yeah.
Now, for retirement, they only allow you to deduct so much every year. And I found that I was in trouble because I could only deduct so much, and I wanted to put it somewhat into another vehicle, and you couldn't because you're only allowed so much. Can we talk about other vehicles?
I'd certainly, we can have that conversation later. I just want to kind of cover on the, we got a lot to cover, right? All right, so next thing, S corporations. I usually recommend S corporations about $30,000 to $50,000 of net income. What the S corporation does, I'm going to use a Mark Kohler here. Anyone know Mark Kohler? So basically this is the Kohler matrix. So basically what the S corporation allows you to do is to break out what's referred to as wages, and you can pay yourself wages. Wages. All right, and the wages should be about 33%. And then the rest of it is dividends. So this is your income that's coming out of the S corporation. Your wages are taxed, Social Security and Medicare. Your dividends are not. So if you're looking at this, let's say $100,000 of net income or net profit from your business, you're paying the Social Security and Medicare on the wages, but not on the dividends. What is 15% of $60,000? $9,000. So the S corporation in that case would save that individual that set up the S corporation $9,000. Yeah.
Could you do employee loan?
Yes and no. They get kind of funny with the S corporations, but yeah, you could do an employee loan.
Is there a time limit as to when that has to be paid back?
It just has to be reasonable. Yeah, you have to have all the documentation in place. You have to say this is the interest rate. This is, everything has to be arm's length transaction. But yeah, you can take loans out of. Yeah. All right, so S corporations are really cool. S corporations, I'm also going to throw this out, have a really cool benefit of allowing you to rent your home to your corporation and take advantage of a little known loophole, which is the 14-day rental strategy, which means you can rent your home out tax-free up to 14 days. So if you're renting your home to your corporation, you essentially take money out of this pocket, put it into this pocket, and it's completely tax-free.
14 days a month?
14 days a year. So if you rented your home to your corporation,
For a party.
not for a party, it can't be entertainment, it's got to be like a business meeting or something. Good question. So you did $1,000 for 14 days, that's $14,000. So $14,000 completely tax-free, right? So if you're at a 32% tax bracket times 14%, this is too much math. I'm getting, if you noticed, I stopped doing math.
Numbers.
All right, so rent your home yourself, tax-free. Anyone do Airbnb or anything like that? So if you want to do Airbnb or anything like that, you probably, or know anybody that does Airbnb, there's that 14-day, the good Airbnbers, the guys that know what they're doing, they have that 14-day window. They say, the moment I rent it out for day 15, I have to pay tax on all that income, right? So some people strategically only rent out their Airbnb or their VRBO for exactly 14 days so they can get it all tax-free. S corporation, rent your home, that's cool. All right, I think we only got like 20, 30 minutes, so I'll run through. 2018 tax law changes, right? One of the biggest changes of 2018 tax law, I'm not going to go into the personal stuff because you guys have probably read that stuff online, the changes to the $10,000 cap, anything like that. But what I really want to talk about is the business stuff. So the business stuff, the biggest changes are the bonus depreciation, which I mentioned earlier, which basically lets you write off anything for your business. So if you need a new laptop, if you want a new projector, if you need a chair, you basically write that off 100%. There's also what's referred to as Section 179. Section 179 properties was really big. About 10 years ago, they called it the Hummer tax loophole for people buying a heavy vehicle. It's SUVs over 6,000 pounds. But now with the change with the bonus depreciation, you could throw the bonus depreciation on top of 179, and you can write off a heavy SUV over 6,000 pounds. You can write the whole thing off in year one. Right. So let's say you have $300,000 worth of income, and you're at the 32% bracket because you're at $300,000 of income. If you bought a $100,000 brand new SUV, a Lexus something, right, or Mercedes something, right, you can literally knock your income down to $200,000, and you saved about $33,000 just by purchasing a vehicle. It could be new, it could be used, it could be financed, it could be cash, however way you want to do it.
That's new. That's part of it. It's new, right? Is the used vehicles.
Yeah.
They used to not be used.
Exactly right. Yeah. Also with Section 179, they included roofs for rental properties and commercial properties. So if you know anyone that has a commercial property or a large rental multi-unit and they've been kind of holding out on doing a new roof, now is the best time to do a roof because you want to take advantage of that 179. Fire sprinklers, security systems, stuff like that, they threw that into 179 as well. So now you can write off all that up to your income. So the 179 can't create a loss, but you can take the write-off against it. All right. Just want to let this out. Okay. I've been going fast. All right, so next thing I have on my list is LLC versus S corporation. I get this question all the time. Do I want to be a Schedule C? Do I want to be an LLC? Do I want to be an S corporation? Do I want to be a C corporation? And my answer is, why not all four, right? There's some benefits you have over here, there's some benefits over here. As long as the tax works out, then it's better to do all you can, right? Now, when you're working with fix and flips, because I know there's a couple of fix and flip guys here, do you want to be a California LLC doing fix and flips?
No, probably not.
No. And the reason is because California has this amazing thing called franchise tax. There's the LLC tax and the LLC fee. As soon as you do your first fix and flip that's over $1 million, which most of them are close to that or equal to that, right? You now get hit with an additional franchise tax on top of the franchise fee of $800. If you do 5 fix and flips, that comes out to over $6,800 in taxes, not including the fee. So 68 plus 8 is like
So over millions per property or general?
just one flip, right? Because what happens when you do a flip, it's considered revenue. When you sell a flip, right? Then the sale of the flip, the whole property is considered revenue. So that immediately puts you into $1 million revenue mark when it comes to the LLC.
It's under $1 million, it's fine.
Well, it gets stacked on top of each other.
Oh, so it's like combined total of $1 million, not each property.
Yeah, yeah. So what happens is the LLC fees keep going up and up and up, right? So if you do 5 fix and flips that are over $1 million, right? You purchase the property and sell the property. If you do 5 of those, you're looking at extra $6,800 in taxes every year, just because you're an LLC.
And you said it was the whole property value, not just the net profit?
Correct. Because what happens is on the LLC, you're taxed on the revenue.
And does that include partnership? But on the S corporation,
If it's an LLC.
it's taxed as an LLC.
Yeah. So that's why if you have an LLC, you want to do an S corporation election. There's 2 forms. There's an 8832, which says I have an LLC and I want it taxed as a corporation. And then the 2553, which says I have an entity taxed as a corporation. I'm now electing the S corporation status.
Sorry, could you see that again?
Yes.
Yeah, so it's the 8832, the entity change, and then the 2553, which is the S corporation election. And what that does is it signals the state of California, I'm now an S corporation, and you don't have the franchise, the LLC franchise fee. California taxes the profit of an S corporation at 1.5%. They tax the revenues of an LLC. So if you have the choice between an LLC and S corporation, do you want to be taxed on your revenues or do you want to be taxed on your profit? Profit, right? No reason to pay an extra $7,000 a year So I actually had a client come to me that was doing fix and flips for the past 3 years. She was an LLC. And she didn't know about this, and she actually had an extra, what is that, $18,000 in taxes. So what we did, because she was working with me, and I know the rules, you can do a late S corporation election. And she basically said, hey, I was supposed to be an S corporation. I want to be an S corporation. We did a late election, and we got rid of those $18,000 of franchise taxes. She was really happy with me.
I bet
Yeah.
you was.
So what about an out-of-state LLC doing business in California?
Good question. So out-of-state LLC, what's going to happen is California says, are you doing business in California? Are you managing things in California? Are you making decisions in California? If you are, you're a foreign corporation doing business in California.
So what do you file in California?
You file the same thing.
What?
You file a foreign corporation.
What kind of corporation?
A foreign. You're foreign
Corporation.
foreign corporation doing business in
If you're an
California.
S corp in California, you don't have to do that, right?
Yeah, you're California. It's the same tax
Is that what
forms.
you do?
What's that?
You take the LLCs out of state and then have an S corp in California?
If you want to, I mean, there's some guys that, attorneys that'll charge you, an arm and a leg, and they'll say, oh, you can be in Nevada, or you can be in Delaware, Wyoming, and we're going to set up this structure, and da-da-da-da-da. I mean, you could do that, but if you're doing business in California, that's going to be taxed to the Franchise Tax Board.
How about a rental property out of state?
As long as you're not making decisions in California.
So if I want to change the rent, I have to fly somewhere and then do that.
Right,
Go up into the
right.
cloud.
Or delegate those decisions to the property manager.
Right.
Right? Right. So if you have rental property in Illinois and you have a property manager in Illinois, you say, hey, I want you to fluctuate the rent based on market conditions.
Get those decisions.
And then those are decisions that are made in Illinois and not in California. And that saves you $800 a year.